Welcome to Cherry Street Investor Education with Kavitha Baratakke, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavitha Baratakke.
Good evening, everyone. Welcome to our webinar on when is the best time to invest in real estate. I'm Kavitha Baratakke, founder of Cherry Street Investment. We have all seen a lot of economic changes happen in the last year with the Federal Reserve increasing interest rates at a never before seen unprecedented steep rate. It's impacted a lot of real estate. And that kind of leads me to this topic today about when is really the best time to invest in real estate. We've all been sitting back. In fact, I've been sitting back. I took a break and I went out traveling because I felt like we needed some time for the market to cool off, right? Like the market was really hot and the Fed started increasing interest rates and then it's really started tanking. So I really wanted to see some sort of a bottom out phenomena. We can never really time real estate, but we can look at data that's available to make an informed decision to see if we've perhaps hit the bottom, right? And the good thing about real estate, and I always believe this, is that you don't buy real estate for a day or a month or 2 days. You buy real estate for the long term. That's the way to make money in real estate. So it doesn't really matter if we've hit the absolute rock bottom, because we know that we've bottomed out quite a bit and we have room to run up, right? But if you bought it during the peak, you have no room to run up. It's only run down, right? So the big change with the the big change that we've seen with the economic impact of interest rate increases is directly on the mortgage rates. So it's made it really that much harder to buy real estate because one, inflation increased the cost of buying real estate, and two, now we have all these economic changes with the interest rates which impacted the mortgage rates. So it's a great time to buy, especially if you can solve for the financing piece of real estate, right? So today I want to talk about the economic impact of the Federal Reserve rates and also look at the 2024 forecast as far as where the rates are going. Is this the bottom, right? And then we'll look at the asset allocation and just talk generally about asset allocation and investing into real estate, why people invest in real estate, and how to close on some real estate deals even in this environment, like how to identify some of the opportunities. And I'll touch upon some of the opportunities that you can investigate further. The plan is to go from here into more topics. Let's say people are interested in single family. I do believe that this might be a great time to get into single family. So we'll talk a little bit more about that in the next topic, in the next webinar. So we'll leave some time for Q&A and then we'll close out. So a quick disclaimer here. This information is always for educational purposes. I'm not selling anything. I'm not offering any advice here that you should go out and immediately act on, but rather educate yourself, learn about all the ramifications of what's happening around us, and make an informed decision on what you're based on your risk tolerance. Please consult your attorney, financial advisor, and CPA for any specific tax situations or investment matters. So a few housekeeping items. Everybody is on mute automatically. It's a webinar format. But if somebody wishes to come on and share their thoughts, I'm happy to unmute you. If you have any issues with audio visual, please type it in the chat box. I'll make sure everybody can hear fine. All right. So if you have any questions, feel free to type it in the Q&A box. I urge you to not use the chat box because it becomes easier for me to go through the Q&A box and make sure I answered all the questions. Or this webinar and all webinars that I put together is sent and recorded to all attendees within 2 days. If you're missing the recordings or it's going to spam perhaps, please add my email, kavitha@cherrystreetinvestments.com, to your contact list. All right. This doesn't want to move. Okay. All right. Just a little bit about me. For a lot of you guys on here, you already know me. You've been investing with me for the past few years. For those of you who are new on here, I moved to US in 1998. I'm an immigrant from India. I went to Texas A&M for a master's in computer science. So really a software engineer by education and a real estate investor by choice. I financially freed myself using real estate. So obviously it has worked out for me. And I do believe it's an amazing asset class to create wealth long term, right? So I quit my full-time job in 2019 and I started my business, where it's just Cherry Street Investments. I did hit financial freedom in 2019, but being as young as I was, I didn't want to sit around. So I had to start a business, learn, and I wanted to also educate people about real estate investments. That was the goal. And also offer some opportunities in real estate because I started uh, getting into the commercial side of things. Besides that, I also have a life insurance license and I deal with a specific aspect of insurance called infinite banking, which is a very interesting concept where you can use an infinite banking policy, a life insurance policy, to invest into real estate and sort of double dip into the policy. So if you're curious about different ways of manipulating money and using life insurance policies, you should look into it. I am an empty nester. My daughter is at UT Austin. She just left home last year. I'm an avid traveler as well as a dancer. So just mentioning my recent adventures. So the financial freedom is not really so much about money. It is, but it's the time freedom that you get from having a cash flow situation without having to have an active job for it. So I took the opportunity after dropping my daughter off on campus at UT Austin, packed my house into self storage into 10 by 10 and left the country for 3 months. I traveled 7 countries throughout Europe and Asia. I don't know how many, 25 hotels, Airbnbs throughout the world. Took, I don't know how many flights, buses, and trains. But I did have my yoga teacher's training certification to show for it. I spent a month in Bali getting my yoga teacher's training, which was long on my bucket list, but just couldn't find that 30-day time to get that training done. I also spent a lot of time with family in India, made a lot of new friends as I was traveling, and also met up and caught up with a lot of friends besides hiking, mountains, checking out beaches, mountains, family gatherings. Happened to celebrate my dad's 80th birthday. So I really feel blessed that real estate and this whole investing journey has kind of allowed me to kind of live life on my own terms. And that's what I want for every one of you out there today, to figure out your own path and then figure out how you can have that time freedom to do the things you really want to do. And for me, that's travel and spending time with the people I love. If you want to follow me on Insta, it's Cav Invest or Kavi Invest for more adventures. So a little bit about my investing journey. As we get into the economic update, I just want to give you a little background of where I'm coming from. I didn't start in real estate. I didn't even explore investing until maybe about 2008. I started investing into options because a colleague of mine at work was investing into options, got big time into it, started trading risky options, right? And I remember I was trading NVIDIA at the time. And if you have been following the NVIDIA crazy journey, I was trading NVIDIA between $9 and $12 a stock at that time. So I wish I had just kept some, but I was just trading options. So I was trading frequently and often, made some money, lost some money. It was really like this sine wave, there were good days and bad days. So I got tired of doing that and I started looking for opportunities around me in 2008-9, which was luckily for me a good time or bad time, whichever you want to look at it, because I feel like all bad times are opportunities in disguise, right? So market was really trashed. Houses were selling for 100,000, 200,000 in Austin, Texas, which is a pretty hot market now. So I figured I had done one trade which was pretty favorable that I could buy with leverage and use that $25,000 that I made to buy my first house for $98,000 in Maynard, Texas, which is a suburb of Austin. So I started getting very cautiously stepping into single family investing. Kind of did that strategy of refinancing one. It was later by called BRRR, buy, refinance, or renovate, refinance strategy, but they really, bigger pockets wasn't really around. There was no real formal term for it, but it just made sense given the rising environment or real estate investments. So anyway, I did that for a long period of time from 2009 to 2017. I just did single family. Got tired of it because it's just hard to scale, right? You manage 10 homes, 10 tenants, something breaks, something's going on all the time. Obviously it's profitable, but there's only a matter of like how much you can manage in a day, right? So then I got into what is called syndications, where I started investing into other people's deals, which were apartment deals. And I also joined a mentoring group to educate myself. From there on, I went to become an active investor in 2019 after I quit my job and acted as a general partner in the deal, and did my first syndication as a GP or a general partner in 2019. And then fast forward to 2024, I've invested in land, multifamily parking, mobile home parks, ATMs, stocks, crypto, all of the above. So pretty well diversified, but still a lot of my holdings are in real estate. So the goal in the next part of my life will be to diversify a little bit outside of real estate, because I do need to buy some other assets, which are a little bit more hands off. So if anybody's buying single family homes, I might be in the selling some. So I do host all of my education, youtube.com/, at Cherry Street. Please subscribe here for more content. I keep posting, and I plan to do a lot more now that I'm back from my little sabbatical. So the webinars for this year, I have a few listed out, and I'll talk a little bit through it. We have a next webinar in March on energy investments and how they can help you save taxes on W-2 income. We'll talk about single family rental analysis. I've jumped a lot into multifamily and commercial investments. I want to kind of go back to the basics and start with just doing a simple rental analysis of a single family unit. Whether it's a long-term rental, mid-term rental, it's not going to change a whole lot, but yeah, some things get added on for mid-term rentals or short-term rentals. We'll talk about some creative financing strategies and how to buy in this market. I don't have the time to go through that in detail today. I'll just touch the tip of the iceberg and leave that for another webinar. Sorry. I have talked about something called Passive Income 101, where I define what passive income is and talk a little bit about how to create multiple sources of income, why it's important, etc. You can look back in my videos on YouTube for it. But I'll cover a little bit. We'll start talking about the next step in passive income, because some investors have reached out and asked, hey, how did you transition? How did you create more passive income? So I want to talk a little bit about that. And I also want to talk about lucrative side hustles that you can do while you're working a full-time job. So you can kind of add in more options to your investing or to your sources of income. So the goal is always in the financial freedom to create as many sources of income as possible. Along this journey, I have a series of webinars I want to call the Success Series, because I think it's not only important to look at your financial life, but also who you are as a person and how you're handling where you are, like in terms of emotions, in terms of how your mindset is when it comes to money. So I'll be talking in the Success Series about how to handle life transitions. So let's say you're going through some kind of a life transition, whether you are an empty nester, like I'm an empty nester. You're going through a divorce, you're going through your kids, you just got married, or you're just having kids. How do you handle all that and still focus on your end goals, right? Like I want to talk about something non-investment, but it ties into who we are as people and affects our everything, right? We are not like, oh, we are not like an investor only, but we have all these other hats we put on. Another person asked me recently on how do you transition to entrepreneurship, right? Like, how do you go from a job to being a business owner? I want to talk a little bit about that too. And if you have any other topics, I'm happy and I'll take your suggestions. So let's get started. 15, 19 minutes into it. I think we can get through all of it. So let's look at the 2024 outlook as well as expectations in the market from a general economy standpoint and also specifically from a real estate standpoint. So overall, we don't know if it's going to be a recession or a soft landing. We don't know yet, right? We are at the beginning of, by 2024, we should, end of 2024, we should comfortably or uncomfortably be in either one. So overall, let's talk about the 5 overall highlights here. We anticipate slower economic growth. And by the way, this data is directly from cbo.gov. You are welcome to go in and check for it. Look for these graphs and everything else. I also have been attending a lot of webinars put out by economists and others during the beginning of the year. So I'm kind of summarizing my learnings from them to you guys. So slower economic growth. We have had a very tight monetary policy with the Fed increasing rates at an unheard of pace to control inflation. So that's resulting in higher unemployment, and the labor market will continue to soften further, right? There are some sectors of the labor market which will stay strong because the dollar per hour labor, like $13, $15 under that per hour, like restaurant industry is going to not, they still need people. So that will stay strong. Lower inflation overall, and it's heading downwards. We saw a little dip up in January, but overall on the downtrend, right? We expect it to be down low and maybe slightly peak up in 2025. That's our expectation, but not too much. So in the declining interest rate environment, with the declining inflation, we expect that the Fed Reserve will respond by softening, doing some rate cuts. There are 3 projected rate cuts, the first of which is expected in Q2 of this year, based on the data that we have. But realize that the Fed responds to what the inflation data tells them, and then they decide. So January data was not very good, so they held back and they didn't do the rate cut. So once the rate cut starts, the optimism grows, and they don't want to make people too optimistic because that pushes up spending, increases inflation, right? So it's kind of like a tough balance that they're handling. The overall GDP growth is also expected to decline in 24 and rise in 25 after the Fed responds with the rate cuts. The risk of recession last year was around 66% because nobody was expecting a real soft landing. They were talking about it. That was the goal, but nobody really thought that was very possible because the probability was around 66% last year that we might have a recession, which was pretty high. And this year it's under 25%, depending on who you talk to, right? There are different sources of, or different people who, or different groups that predict the recession or the risk of recession or the probability of a recession. So overall, things are looking good, but we have a lot of risk factors. So let's talk about the economic wildcards here, any of which or all of which could completely change what 2024 looks like. So we have very stubborn inflation. If the inflation continues to be stubborn, it's been yielding to the Fed's in decreasing interest rates or increasing interest rates. But if they drop and it jumps up, Fed's going to be very strict on controlling it, right? So if inflation continues to be stubborn and people continue to have a lot of spending, then it's a problem. We have rising geopolitical tensions. We have wars in the Middle East. The world is a very uncertain place right now, right? Wars in the Middle East, Eastern Europe, those pose a risk to the soft landing. We have the uncertainty of it being an election year. So we don't know how does how that factor will play out. So that poses a risk. And this is probably one of the biggest ones, which is the potential risk rise in oil prices. Because what I learned very recently actually is that people are most sensitive to increase in gas prices. If gas ticks up, people assume that things are all hell has broken loose, right? So the pessimism creeps in and recession kind of sets in when oil prices high. So anyway, the prices have been pretty low, but recent attacks in Red Sea because of the Middle East tension is disrupting the shipping through the Suez Canal. So that's going to be a factor we have to watch very carefully. And then there's all these other risks with climate change. We have unpredictable weather patterns causing huge insurance damages, potentially huge damages to property and cities around the US. A lot of financial stress right now with real estate being on the brink, right? Like because the interest rates are so stressed, a very weak Chinese economy, and China has been a strong economy for years now. So all of these pose like economic wildcards or risks to this, where how 2024 will go. So we don't know if it's going to be a recession or soft landing. And in my opinion, it really doesn't matter either ways. We'll get on the other side because I do believe that whenever there is a low, there is a high after it, right? And the question is just like how much longer do we have to wait for it, right? So Warren Buffett is probably one of my favorite people in the investment world, and he said, "Be fearful when others are greedy, and be greedy when others are fearful." I do believe that there's a lot of fear in the market. Maybe not the stock market because we've seen phenomenal gains, and that's where I am fearful. S&P 500 has gone up 24% last year. I'm fearful because everybody's being greedy. They think every year will be an 24% S&P year. It won't. It can't, right? So I'm cautiously stepping into the stock market for sure. But if you dollar cost average and buy over time, I think it's fine. And if you're in for the long haul, you should be okay. But I believe that whether it's a recession or soft landing, there are massive opportunities and fortunes to be made, just like 2008. When there was fear in the market, there were opportunities. So this is a great time for new and up and coming entrepreneurs to go start a business, to buy real estate, to do all these things that if you've been sitting on the back end or sitting back and thinking, oh, now's not the time. Now is perhaps the time, and I'll talk about why. So the silver lining is that the lower prices obviously create economic or buying opportunities for us. Market downturns invariably always lead to innovation. So when things don't go well, people figure out how to make it better, right? So obviously there's a lot of artificial intelligence is playing big time into, although it's like a little buzzy for me, but I see the practical applications. I'm actually doing a course in AI and marketing at Darden right now. So I think there's a lot of pluses here. Downturns lead to also weed out weaker companies, right? If people are weak, or companies are weak, they fold. So it keeps like the survival of the fittest Darwinian theory comes into play during a downturn. Downturn can also help rebalance portfolios. And the last one, but not least, is that it can be a great time to invest in alternative assets, which is what today's presentation is all about. So before we jump into real estate, I just want to cover a few investing 101s here. I think there's some rules of investing that we should follow because it's healthy, right? I have some people who will jump into something because it sounds gimmicky or it sounds like a quick buck. I don't believe in that. I believe in long haul investments, being patient, not trying to time the market, but being educated about when to get into the markets, right? So I think the first one is define your money goals, define what 1 year looks like, define what 5 year looks like, right? Have a long-term outlook. I think that's super important. Trading options, I realized that although it sounds good, it makes some money, but it comes with a lot of risks and a lot of stress. So I think making money slowly, It's better than making money fast and losing fast, right? So when you have a long-term outlook and invest in value properties, value companies, value, and look at some growth as well, but don't go for the gimmicky stuff. I think long-term outlook is important. And I have a lot of people who panic when the market turns, right? Or during this downturn. They're panicked and they just want to sell. I don't believe in that, right? I don't believe in selling when things are hard because you just have to know how to tide it. If you can tide through the hardship, you come out on the other side, you're better off for it. You learn a lot, but you also have an opportunity to make money. So sometimes holding is better than not holding, and which is why timing real estate is not really that important because long term holds kind of irons out, even if you didn't hit the actual bottom. Also, review your portfolio regularly and often. Know what you have, know what you're invested into, know what you want to get into, and understand the investment. Educate yourself about that specific investment you're trying to make. Try to understand most of it, right? If you give your money to someone like a financial advisor, it's a different story. But if you're trying to put money into places you don't understand, you're probably likely to lose it. So, a book I recommend here is called The Rich Man of Babylon, I believe. Richest Man in Babylon. I think that's the book. I read it recently because it kept coming up on with people asking to talking about the books to read. I highly suggest you do it. It talks about how Babylon was very prosperous and how this particular person talked about investing. So anyway, read it just as an aside. And never try to time the market. You never know where the bottom is. You can just say, okay, this is a good time for me to get in. This makes sense. And diversify. The reason I say star for the diversify is if you look at the really wealthy people, they don't actually diversify. Some of them are heavily into one particular sector, but they understand that really, really well. Like you could find an oil tycoon who's completely into oil, or you could find a real estate tycoon who's completely into real estate. From the outside looking in, you're not diversified, but they know it so well, they know how to manage it. But for those of us who are just dabbling into things and trying to figure out how to invest our money, it's better to diversify because then you don't know enough about everything. So it's better to diversify and put your eggs in different baskets. So it might be high, low, and you kind of average out. So when we look at asset classes, here's something I want to talk through. A lot of people, when you say investing, only think of equities or real estate, very broadly. But or equities and bonds, stocks and bonds and real estate. But there's others too. There's ways within real estate of doing investments, right? Besides going and buying a house. So I just want to kind of talk about the equities and bonds most people are familiar with. But when it comes to property, you can buy a property directly, or you can invest it through shares in a real estate investment trust like a REIT. You can also buy direct direct property, like I said, buy a rental property or buy a multifamily. You can also invest into private equity, which is what I typically do, is organize these smaller private equity funds, and we go buy a specific type of property, right? Or we do a land deal, let's say. We go buy land and we entitle it and we sell it. So real estate can be done in various ways, and most people are stuck in this idea of buying a house as the only way to buy real estate. It's not. And real estate also doesn't need as much money as a single house perhaps does, right? So there's various different ways to invest. Like if you invest in a REIT, you can invest in a REIT as little as $100 a month. You also have cash investments. Cash is pretty good right now, 5%, 5 quarter, depending on where you're investing. Great right now, but it won't stay there very long because that's tied into the Fed funds rate. So it's going to start declining, right? By next year, we might not be even at a 3, or maybe we are at a 3 or 4, but not great long term. So let's talk about why invest in real estate. I believe that real estate is a long-term game, and there's some key reasons why real estate works so well. Property values do appreciate over time. One, in a single family home, that can be based on comps or the sale values. In multifamily and others, it can just be like a hotel or a multifamily. It can be based on the income of the property, the revenue generated by the property. The population growth in the area and other supply and demand constraints will also lead to appreciation. The second one is tax benefits. In stock market, crypto, and other investments, you can have massive gains, but you also have massive taxes, right? Whereas in real estate, there are a lot of tax benefits via depreciation because real estate is an asset, is a tangible asset. You can actually depreciate the asset or claim losses for the depreciation or the usable value in the house, for example, depreciates over time. The air conditioner has a lifespan, the utility or the plumbing fixtures have a lifespan, so you can depreciate all those assets. And also for the 1031 exchanges and other facilities provide for a lifetime of tax deferral. So you can keep a property forever, pass it on to your heirs, and or if you can invest in another property without any tax implications. So those benefits that we have in real estate, you really don't have in the stock market or other investments. The equity, when revenue is generated, it pays off your mortgage or debt on that particular property, thereby creating equity over long-term holds. We kind of tend to minimize it and look at only cash flow sometimes, but that can be really powerful when you hold property for a long time. You know, your equity pay off and then you just pretty much pay it off, and someone else is paying it off for you. The cash flow generated is also generally a tax deferred because there's enough depreciation, so you can really offset the cash flow and not pay taxes on that cash flow. It also helps you create multiple streams of income. Let's say you have 10 rental properties, you have 10 streams of income from it, right? So all these little things kind of add up over time. Recession hedge, because of its tangible nature, recession or not, in fact, in a recession, real estate is a great hedge because you can use leverage. So if you invest in the stock market, you have $25,000, you only have $25,000. Because you have this ability to use leverage, and even though leverage is expensive right now, there's ways and means to buy it using other people's leverage. And there's also a very finite source of real estate, and housing is actually, there is a shortage of housing overall, right? And we're going to talk about why as well. There's also inflation. This is also a great inflation hedge because when inflation, the cost of everything goes up, real estate goes up because building materials become more expensive. And we've experienced that firsthand over COVID, right? Post-COVID, prices have gone up pretty steeply. So let's look at the range of asset classes within real estate. So these are all your investment options, not just buying a single family home. We have small multifamily, which is usually under 1 to 4 units. We call it residential. When it gets to anything 4+ units, it becomes commercial. So you could have a small apartment with 10 units also. You could have a large apartment with 300 units. You can invest in office. You can invest in real retail, senior living, self-storage, medical offices, industrial warehouses, factories, special purpose like mixed-use buildings where you have retail and then apartments on top, raw land, farmland, school, churches, whole bunch of different asset classes. So I'll talk about which asset classes kind of rise to the top in terms of buying opportunities as well. So any questions so far? I'm just looking at the questions. Okay. So let's look at the real estate outlook. Some graphs here. And I want to talk about this to explain why we are where we are and why my outlook is pretty positive, really. So interest rates are really high right now, right? Like we're looking at the 7s, right? I think it's depending on how much you shop around and where you get, you know, if you buy down and all that stuff, that's different. But interest rates, like 30-year mortgage rates, around 7.3 last time I checked. So Fannie Mae, Redfin, NAR, National Association for Realtors, Wells Fargo, and MBA, they all have different predictions of forecasts for where the real estate mortgage, specifically the 30-year mortgage rates will be. And it's down, but it's not down like a whole lot, right, this year, because we're not anticipating a huge amount of cuts from the Fed. So the actual will really depend on how many rate cuts we'll see and how it impacts that 10-year treasury, based on which the 30-year mortgage follows the 10-year treasury. So we're expecting 3 rate cuts. So I think what's important to take away is that declining trend, right? So when interest rates go down, real estate goes up, right? So we might not have hit the absolute rock bottom, but the good thing is there's nowhere to go here from here but up. So even if there's a blip in these charts and that doesn't go by these kind of exact forecasts, we are in a declining environment, and that's what's important. So look at the commercial debt. It's based on something called SOFR, or secured overnight financing rate. All our lending in multifamily, hotels, and all the other commercial real estate is based on SOFR rates. So it's a pretty market consensus forecast is pretty positive, about 100 basis points decrease. Right now, we're sitting at about a 5.3. We're looking around a 4.25, I believe that's where this point was. It's a 4.3 or close to 4.3. So we're looking about 100 basis points drop. So generally, commercial lending is SOFR, plus we call it a spread, which can be dependent. The lender needs a spread to lend to a borrower. So it's SOFR plus 200 points, SOFR plus 285, whatever that is. So if the SOFR comes down, so does commercial debt debt rates, right? So I do believe that we are going to see some opportunities for better rates, but there are also opportunities for loan assumptions in the commercial space. Distress sales are going to come up, and I'll talk about why. So there's going to be some opportunities there in the commercial space as well. So let's look at one important factor that plays into commercial debt maturity. We have a lot of commercial loans slated to mature in 2024 and 2025, over $1.2 trillion. That's like a massive amount of loans set to mature the next 2 years. The reason this is critical is that all these people will be refinancing, and a lot of them might not have equity in the deal. So there have to be foreclosed, short sale, whatever that might be. So we are going to see some deals hit the market in the commercial space. Guaranteed, right? It's already happening. It's going to pick up more by Q2. So because of the refinancing issues, like I mentioned, people bought really high, and so they don't have enough equity in the deal. And so when they refinance, the lender proceeds are not enough for them. The interest rates are still very high compared to where they bought it. They might have bought it at a 3%. So those kind of issues are going to result in distressed sales during refinancing. And the two topmost distressed asset classes will be office space and multifamily, office space being the top. So here's a chart that's showing the maturity of different types of real estate asset classes. So the blue highlights multifamily, and purple is office space, right? So we saw a kind of even office had a pretty bad year, and multifamily did too. Next, this year, actually, a lot of multifamily refinancing is due, or debt is maturing. And we have office as well. Office is actually number one because their occupancy is really low and they're really struggling, even though the numbers here show multifamily as a higher number of debt maturities compared to office space. And then we have industrial and others. So out here, there are less likely to be deals, but there are always deals, right? But there are less chance of finding deals than down here, right? So I think the top two spaces again would be multifamily and office space for distressed deals. So where are the opportunities? Single family and small multifamily homes, 1 to 4 units. I'd say not all markets have taken a hit. Like Austin stayed pretty strong. I mean, prices seem like, oh, did we just go through a bad time here? Like, why aren't prices down? But they are. So you kind of have to zone in on areas maybe outside the city, which will grow. right? Builders are actually having an oversupply in some areas, so they are willing to do good deals and give you great interest rates for a year or two, like New Braunfels, San Marcos outside of Austin, Elgin. So you can get a good home from a builder for a good price with a good interest rate, right? And put it up as a rental, live in it, whatever you want to do, house hack. You can, there are so many strategies here that will work. I've seen as in some distressed sellers for single family homes, as the days on market tick, you cut prices, and you're seeing like 50, $60,000 down from the peak. And I'm like, okay, that's a buying opportunity. You just have to figure out the mortgage. If people understand seller financing, how it works, if you're able to talk to them, most realtors don't understand seller financing. They'll just say, my seller is not willing to do seller financing. So you really have to sit down and explain the math to the seller. So usually seller financing, there's a balloon. So they are paid and made whole in a few years, but till then they collect monthly income from you, because essentially you're taking over their loan, one, or you're paying them so they can pay their loan, right? Then there's large multifamily. A lot of people are actually staying put in their homes, which I'll talk about as well. Then there's large multifamily. There's a lot of opportunities if you've already been in the multifamily area or you want to passively invest in a distressed deal. I think there'll be opportunities coming up there. If you are inclined to start a business, this is a good time. There's so many new and existing businesses that, people are aging out. We have a lot of aging population, baby boomers aging out, and they just want to sell and they want to get out of this. They just want to retire, right? So there's a lot of new and existing businesses up for sale. A lot of office spaces, and in the new and existing businesses, also franchise opportunities for doing different things. In the office space, opportunity to buy small offices and convert it potentially for other purposes, because office space is really, there's the oversupply and all this hybrid work model has really killed office space industry, right? There's a lot of if you're more of a passive investor, hey, I don't want to mess with all this stuff, I don't have the time for it. Maybe you want to invest in a REIT. A lot of REITs have been slashed and beaten down with what's happened in the market, but guess what? They'll be buying and coming back. So I do think that REITs will perform well in the next, the past year performance is not indicative of future performance in REITs, because real estate has taken a beating, right? And it's good. When it's taken a beating, you have an opportunity. Private equity, same thing. If you can get in on a distressed deal, make sure you do your math or do your homework. I also believe there's a huge opportunity in education, whether it's artificial investing, artificial intelligence, investing, business coaching. If you can educate yourself or you can get into business because you have a skill to market, I think that's a great area. So let's talk a little bit about real estate. Since I focus solely on real estate, is that housing pricing has corrected about 10 to 15% in most markets so far. Austin has seen about a 15 overall percent decline, which is good. I wish there was more, but that's what it's seen. There are always distressed sellers in every market. So you just have to know how to find those opportunities. And I'm planning to make a list of things that I see and send it out. So you guys can contact me if you're interested in, looking at it further. Oversupply in certain areas. There is an oversupply, which means the rental can be affected, but generally rentals are doing very, very well. No issues in renting because people can buy. A lot of people can buy with the current interest rates. That they think it's too high, they're just holding. Prices are high, interest rates are high, right? Residential sales have actually seen a tick up in Q1 24 so far. There are a lot of frustrated sellers as well due to increase in days on market. They are willing to do a deal. Again, you can creatively structure a deal for a win-win situation, give the seller some down payment, and try to either sub to, and we'll talk about that in another slide. Let me not get in here. And owners are staying in their homes longer. Like if you locked a sub-3 mortgage, like a 2.6 rate on a mortgage, you don't want to move right now because why am I going to sell my house, which is a 2.6%, and buy a house in a 7% environment, right? So that's causing a lot of people who actually want to move to stay in their homes. So constraints, right? But if you can get these people out of their home and still they get into a new home, they're willing to move, right? Or people who really have to move and don't have a choice because of jobs and other things will sell. What's happening in the commercial real estate? I'm on the front end of it right now, having owning commercial properties with my investors. We have interest rate hikes. We have high property taxes. We have steep insurance increases, 60% insurance increases in the last year. A lot of financial stress in the commercial real estate space, multifamily and other assets as well. Slower than average rent growth, very low occupancy is a problem in certain areas, depending on the supply of units, right? The cap rates have expanded almost 100 plus basis points, and depending on which class of property, there's A, B, and C class properties. So depending on that, the expansion's a little bit different, but average out 100 basis points increase. What that really means is higher cap rates translates to lower value for that property, okay, given the same income. We have, like I mentioned earlier, many times, we're going to see more distressed properties on the horizon in the commercial space in quarter 2 24, when there's a lot of debt maturity is hitting the market. Opportunities in multifamily, office, senior living, land. Land is another great opportunity that people are not exploring enough. I should add it in the list of things that you should look at. Buying pieces of land, entitling land, if that's your gig, is a great place to be right now. You can put like a 6-month, 12-month due diligence period, take your time, figure out everything, and then close and lock in the price right now. So, highly lucrative. So, seller financing. What is seller financing? It's also, we call it wrap. It can be wrap or what we call a subject to. What that means is, in a subject to, you just take over someone else's mortgage and you pay it. You can get them out of the house. You can pay 10% down, 20% down, whatever it is, and then take them out of the house. And let's say you're taking over the loan, you pay the loan directly, and then you also pay the difference between the loan and the value that you agreed on to the seller, amortized over 30 years or whatever, every month to the seller. So it can be a great source of income, especially for an older person who's trying to sell a house. Monthly income coming in, amortized over however long they want. Like maybe they want to do only a 3-year period and then they want their entire money back. So this is the time to creatively structure deals depending on who the sellers are. And this is also the time you can also wrap a mortgage. So let's say I have a 2.6% mortgage. I can set up a note as a seller for a 5.5% mortgage, which people are willing to pay me right now, given that the market rates are higher. And I can collect the difference between the two. I collect a 5.5% rate and I pay my mortgage. So the payment is coming to me. I become the lender. So wraps and sub-twos are a great way to buy properties right now. You just have to know how to deal with the sellers, right? So whether it's a for sale by owner seller, whether it's a real listed MLS listed seller, it doesn't really matter. It just depends on how motivated the seller is. Sub-two strategies can help you take advantage of that underlying mortgage. Even if it's like 4%, 4.75%, it's better than what you would pay with the lender right now, right? And you can set up like a 3-year term and then refinance after the 3 years, and it's a balloon payment. You pay that entire sum by refinancing it into another fixed rate loan in a couple of years. So in closing, I am out on time, but we'll do some Q&A. I think this is a really important time because we are looking at ourselves. We are entering a new era of growth and consciousness in the world today because there's so much around us. COVID has made us realize that, hey, things are not that important. It's not so deep. Life can be, the mortality factor is kept in with a lot of people. They value lifestyle. What I like about the younger generation is they really value lifestyle and balance in life, and they take time out to spend more time with themselves and with other people around them. And so we need to grow more, not just financially, but also spiritually, emotionally, and physically take care of ourselves. And more holistic growth has become a thing now. And I think in keeping with the investment aspect of it, education is the most important investment. Investment in yourself, which pays off in the long run. New ways of doing things will be changing. AI will be changing our world. It's happening, but I don't look at it negatively as, hey, it's going to replace a job. No, it's going to make all the mundane and rote jobs go away and going to give us more, free up more of our time to do the jobs which actually challenge and help us grow, right? They replace that traditional model. We will see lower interest rates in 2025, 2026, much lower, but it'll never be that sub 3 rates that we saw, possibly not for a very, very long time, right? Those are unrealistic rates when you look at the long-term rate outlook. So maybe fours, four and a halves is where we'll settle, and that's a comfortable rate to buy real estate. So I do think that there's a lot of room here to play, and this might be a good buying opportunity for most of you out there who've been sitting on the sidelines. So with that, I'll take some questions. Please type it in the Q&A box. Okay, someone says I'm a real estate investor by passion, not by choice. I'd say yes. Probably started by choice. Can you talk about investing in multifamily versus single family for newbies, pros and cons? 1 to 4 is not really multifamily. The way you treat 1 to 4 is pretty similar to investing in single family. I think the difference between 1 to 4, like actually 2 to 4, if you really want to be. When I say small multifamily, it's 2 to 4. When I say single family home, it's usually 1 unit, right? So the difference is the tenant profile, possibly. You might have more families with single family home. The appreciation is usually better on single family homes, but a lot of it depends on location as well. With multifamily homes, usually the valuation is harder. So we rely on net operating income, like the income you're making from the property, not the revenue, but the income, revenue minus the expenses, which is called the net operating income, to value that property, right? Whereas in a single family home, it's based on comparables, like what other properties are selling for. So those are the difference. But I love multifamily or even small multifamily because if one tenant isn't paying, the other 3 are, hopefully, if you have 4 units. Whereas in single family, it's a 0 or 1. They're paying, they're not paying, so you don't have any income or you have income. So there can be advantages to even the small multifamily versus a single. If you have any other questions, let me know. All right, if I were to start all over again in real estate with knowing what to do, where would you start? Oh, good question. Personally, I won't do single family. I'm done and burnt out, but that's more from my own experience. I've spent 13 years now, handled the worst of tenants, the best of tenants, a lot of work. And you have to understand that single family investing is not passive, even though it's considered passive income. It's not passive investing. You're putting a lot of effort into it, like you're getting in tenants. Even if you hire out property management, it's just constant work for you. So if I had to do it all over again, I think I would start with multifamily, to be honest, because it will allow you to scale much faster than single family. But it also comes with its own set of hassles. I've done both, right? Multifamily comes with its own challenges, more units, more issues, bigger issues. So there's no free place like, oh, this is easy, put it on cruise control and run along. There's no such thing, right? Real estate is always not cruise control. It's a lot of hands-on. Which comes to my another point, like I've actually put a car on Turo, which is I have a manager for it, so I don't do anything. He just sends me a check every month. That's probably passive, right? My private equity investments that I'm investing into is a good way to introduce real estate in your portfolio, but again, I'm not doing anything. I like that. As I get older, I think I value my time more, and I don't want to spend time where I don't. It's a lot of work, but it's a lot of reward. If it's not a lot of work, it's not a whole lot of reward. You have to be happy with whatever rewards you're getting out of it, right? So a lot of work, a lot of reward, like higher risk, higher reward, higher effort, higher reward. So I hope that answers your question. Feel free to ask me. In case of seller financing, would the bank agree to mortgage transfer to the new entity? No. So in a VA loan, yes and no. Okay, let me nuance that, clarify that nuance. A VA loan is an assumable loan, but you have to qualify as a VA to be assuming it, right? Self-financing doesn't work like that. Bank doesn't really know that the mortgage is being transferred. Mortgage never, okay, mortgage doesn't get transferred to the new entity. Mortgage payment gets transferred. The the responsibility of mortgage payment gets transferred to a new entity. And the way it's done is one of two ways. One is you start paying. I'll give you my example, and that should make it clearer. I bought bought a single family home in Cibolo, Texas, which is right outside San Antonio, closer to Austin, for 132K. It was a 3-bedroom, 2.5-bath home, 2,300 square feet. Pretty new, 2009 maybe, built. This was about 2018 that I bought it. The sellers were an old couple. They wanted to just go back to Michigan. They had spent a lot of money on the house. They put solar panels and the whole works, but they didn't have enough equity. They had taken a second mortgage into the second lien as well. They were behind on their payments. They didn't want to spend time listing the property, trying to sell it, all sorts of issues, right? So the deal came to me. It made a lot of sense. The house was worth 220 at the time, and they were giving it to me for 132K or less. I think I had to take their original mortgage, which was 122. I took that on, the payments of that. Plus, they had a second lien, a home equity loan for 8,000. So I think all in 132, and I gave them $1,000 to leave, right? Like just to have money to leave. So they left it for all 132 and they were out. They just wanted it done in 1 day. The nice thing about this is it can be done in 1 or 2 days because there's no rewriting a note and mortgage and lenders and credit pools and none of that stuff. Credit doesn't matter. So I paid that loan until last year. I sold the house finally. I paid that loan every month. I rented the house. It was cash flowing. I paid the loan. I paid all the bills, and the loan was still in their name, but they gave me all rights to talk to the bank about it, to transact with the loan. So bank doesn't know that it's a mortgage payment transfer, doesn't care. Nowadays, there's something called due on sale clause, which means that the bank cares. But there's ways to get around it. So what you do is you transfer the property to a land trust. You set up a land trust. Then the mortgage beneficiary is the current owner who's selling. And then after the sale, so the bank knows that this property is deeded to a trust, a land trust. And that's it. They don't care. So tomorrow, if you go say change your deed over to your trust, nobody's asking you. Bank doesn't care. But then behind the scenes, the trust owner or beneficiary actually changes. The beneficiary changes from the seller to the buyer. And the bank doesn't know anything about this. So they don't know, they don't care. As long as the payments are done and they don't have to foreclose, they don't care. So there's legal ways to do it without skirting any laws. And there are lawyers who specialize in doing, there are title companies and lawyers who specialize in doing seller financing. So you want to make sure you're on board with them because the documentation is super important. You have to have the right set of documents to cross your I's and dot your T's, because tomorrow if the seller disappears, you should be able to interact with that mortgage company, right? You're still responsible. You're not responsible, but you don't want to trash their credit, right? and the house has a lien, and you're basically responsible because you've invested into the house. Is it possible to invest in other states where I'm not a resident without any hassles? Absolutely. That brings a great point. There are a lot of opportunities in Midwest still. Indiana, Kentucky, Tennessee. I love Tennessee, Georgia, smaller cities that are growing to invest, to grow your money, lower taxes, lower property taxes. You do have to file taxes in that particular state where your property is, but as long as you have a CPA who can do that, it shouldn't be that much hassle. So the bank doesn't know about the mortgage payment transfer. Yes, correct. Any other tax breaks in real estate investment other than depreciation? So depreciation is a big one, and I can talk about bonus depreciation or accelerated depreciation. So they are actually renewing that bill. So it was 2, 3 years ago, it was 100% of the property could be depreciated in the first year, and it was a powerful tool. And there's also other tax breaks with short-term rentals. There are, you can Google short-term rental loophole. There are active income tax breaks with short-term rentals. So, but you have to be involved in the property management, right? So you can actually take that depreciation and offset your W-2 income if you have a short-term rental property. So you have to make sure that you log your time, show that you're the active manager of the property, but there's a depreciation can be huge. Let's say, I'll give you an example. If you can buy a $500,000 house and claim even a $300,000 depreciation against your W-2 income with the short-term loophole, it's massive. $300,000 is a massive tax break on your W-2 income. So. I do offer mentorship. I don't have any upcoming investment deals. Tejal asked, what's your upcoming investor deals? I'm kind of waiting, still evaluating the market. I might get into a debt investment, which is you get like 8 to 10% every month, like paid over a year, of course. 8 to 10%, 0.8 to 0.9% a month, 8 to 10 over the year, with working as a debtor or a mortgage lender, because I told you this debt maturity thing. If you can lend first lien position, first lien means you have the first position. If the property owner does not pay or the borrower does not pay, you have a right to foreclose and you have a right to that property. That's what a first lien means. So I'm looking at a first lien investment into the property, into multifamily properties, because I do believe there's going to be a big demand for that in the next year, right? So I'll be looking at that. I do offer mentorship. You're welcome to get in touch with me. Here's my contact. You can go to cherrystreetinvestments.com, and I think there's a schedule, a call. Maybe it's not. If it's not, just shoot me an email, kavitha@cherrystreetinvestments.com. I'll type it in the chat box. If you're looking for mentorship time with me, I can set that up. All right. How to become a real estate investor for 1 to 4 units or even commercial, bigger apartments. Commercial, you definitely need a mentor. You need a lot of financial backing for commercial investments because lending is tighter. They're looking at your net worth and balance sheet before they lend on commercial. Real estate, in 1 to 4, they're looking at your debt to income ratio, right? What's your income? What's your debt? That to DTI. So it's easier to get into 1 to 4. If you're not worrying about the lending, if you do some kind of an assumption, none of this really matters, guys. You can buy any property, multifamily, commercial, whatever. Commercial, it's a little tricky because assumption is a thing in commercial loans. And if someone wants to sell, you have to, the way assumption works in commercial is that you have to go through the process with the lender to do the assumption. The lender needs to approve. Residential is a little different. You can do land trusts, you can 1 to 4 units. I mean, small multifamily. You can do land trusts and change hands without ever looking at a lender, right? So that's where I think the gold is for the next year, year and a half, because interest rates are still high. That's the way to buy. I know places, people who have bought hotel deals, who have bought a lot of large short-term rental properties just using seller financing. So there's a lot of seller financing is really common in hotel industry. So do you recommend cities in Texas for residential commercial investments? Residential or commercial? Well, depends on specific of residential or commercial. I'd say a lot of opportunities around the big cities, Dallas, Austin. So if you're looking in the heart of the city, it's going to be more expensive. It's going to be cost prohibitive. But let's say Taylor, Texas, we have even builders with an oversupply or inventory that want to just want to just sell, right? So there are cities outside Texas, like Taylor will do well. I think New Braunfels will do well. Everything in that corridor between San Antonio and Austin will do fairly well. Long term, right? I look at a long term outlook and I don't worry about short term things, blips. There's also multifamily, like 1 to 4 units or even 1 to 10 units in San Antonio. There's still deals in San Antonio, guys. And San Antonio is an up and coming market. So I think I would look there. Austin, like I said, outskirts of Austin, the MSA, like we call it Austin MSA when it's not like Austin City, but outside of Austin, there are a lot of opportunities to buy right now. So if you subscribe, go to cherrystreet.com and you can subscribe to my mailing list. I'll be sending out some properties that I think have potential and a quick cash flow summary and potential value. And then if you're interested, you can get in touch with me. This will be single family or multifamily that you buy by yourself. I'm not syndicating or anything. I'm not offering an investment opportunity. I'm just alerting you and telling you, hey, it's out there. Are there certain documents that you can show that you're actively participating in? I think it's just logging hours, Oscar. Whether you're doing anything for the property, you can maintain a worksheet. I'm sure you can find 100 templates out there for logging hours so I'm a real estate professional for tax purposes, and that gives me a tax break where all my passive losses become active, which means I can offset active income. So that's another presentation I've done with my CPA before. You can look it up. Michael Richimo says, any opportunity with lending hard cash for investments? That's the one I'm trying to set up, Mike. You can definitely do lending hard cash. Lending is between 8 and 10% or so. You can make depends on the first lien versus second lien. If it's second lien, I'd want 12 to 14% right now, because you have to have enough room in there to get your second lien satisfied. It's higher risk. But if it's first lien, I'd be happy with 8 to 10 right now. And it's very, very possible right now. I have an employment gap for almost a year due to family reasons. Is it still possible to do real estate investment? Absolutely. I don't know why your employment gap would play into anything, as long as you have an income and as long as you want to do a real estate investment, you can. Absolutely. All right. Any other questions before we wrap up for today? I'm just looking through all the questions. Okay, so Sunil says it means for getting loans. I don't think it should matter. They're looking at the current income and current debt to income ratios. So it depends on how much income you have and what you're applying for. So keep in mind of this, right? When you buy a rental property, your debt to income matters less, because I didn't have the debt, or I didn't have the income to buy 10 rental properties, right? But each rental property is paying for itself. So the lender is doing a cash flow analysis for the rental. And what you want to do is be ahead of them and do that analysis and make sure that it cash flows. You don't want to overpay for something that is not going to make you money. So that's more important. As long as it makes you money, it won't really matter. Okay. I think Jorge is asking about opportunities that I've been posting, and I have accredited investors only in some investments, which is true. When you get into private equity, it's a completely different ballgame. We are regulated by SEC on how we collect money from people, and we are allowed to do certain kinds of investments for certain types of investors. But if you, as an investor, want to go buy something, you are not limited. You don't have the same limitation, okay, for commercial. But for commercial, you will have income, at least like net worth requirements, even for commercial. Or the better idea is to partner. In commercial, you almost always don't go do a multi-million-dollar deal by yourself. You're finding partners who are financially strong if you're weak financially there, and you bring the strength of time and effort, and they bring the money, right? Or maybe you bring in half and half money, but whatever deal you want to perform, you can raise money, and you can partner with someone like me. I can raise money and bring you the money, and you have to manage the deal. So there are always opportunities to invest. Money should never be a limiting factor, right? When I say investment, it's like manage an investment, not necessarily put in all the money you have into an investment. All right, I think I'm way over time, 15 minutes over time, but appreciate you guys dogging in. I know you're taking time away from your families to come here and learn with me and join me to learn more and grow your knowledge. I'll be doing this, like I said, every month. I look forward to seeing you next month, and thank you again. Next month, we'll be talking about tax benefits of energy investments, and I have a guest speaker coming on for next month. I will talk to you and see you soon. Thanks for joining. Good night.
Hi, I'm Kavitha Baratakke. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.